Hello and welcome to today's webinar, Looking to Buy a Business. Thank you for joining this session today where we will cover the ins and outs of buying a business, ensuring you can undertake the correct steps when the time is right. We'd love to hear from you during today's presentations. If you have a question for our speakers, please feel free to send it through the Q&A tab at the top right of your screen. This can be submitted anonymously if you would prefer to do so. We'll be answering the questions at the end of the session, but if we don't get to your question during today's webinar, we will be sure to follow up afterwards. So I'd now like to kick things off by welcoming Paul Heaven from Jerem's Corporate Finance. Paul, over to you.
Thanks, Sharon, and welcome everybody. This is one of a series of webinars that we do looking at transactions which are likely during the course of the life of your business to be exceptional, rare, unusual occurrences. So this will give you some guidance as to how the transactions of this nature progress. We look at fundraising, we look at sell side transactions as well. This one's really focused on looking to make an acquisition. So what we're going to be covering off during the course of today is the key components on the, if you like, the deal origination stage, which can work a number of different ways. I'll cover in a second, but how to identify targets, how to put the valuation components together, how you can assess the funding structure options, and I'll be inviting one of my colleagues, Steve, to talk through some of those funding structure options, the importance of getting the heads of terms right, securing the finance, and then into the deal completion stage, which will include due diligence, optimizing the tax implications. Again, we've got an expert to join us today, Nick, who will take you through some of the tax implications, and then finally the all-important final stage of getting the legal terms correct. And again, we have a friend and a colleague from a Birmingham-based law firm, Wilkes, Jeremy, joining us today to run us through some of those legal implications. So you won't be surprised to know that buying a business is a process that has been well trodden before. There's a fairly well trodden and established series of steps. In the kind of key pillars that you're viewing on the screen now, you could really contextualize the first pillar as being the pre-deal, deal origination, deal shaping, then into the deal itself in terms of the negotiations, getting the financial and tax structure right, making sure that the necessary components of finance are in place, and commencing the process of due diligence. And then really you're into the final stage then of completing the arrangement on financing, managing the process of due diligence through to completion, and then engaging at the appropriate point the legal team to come in and liaise with the legal documents. So during that initial phase, I did say there were a couple of ways that we see deals come about. I suppose you could best describe the two most common approaches as being kind of reactive or tactical and strategic. This one really describes a more strategic approach to an acquisition mandate. So what we're looking at here is where we work with a client, be that an individual or a company, and they have a specific acquisition criterion, and the more detailed that criterion can be, the better. But we can work with them to look to the market, use the research tools that are at our disposal to see if we can help to identify a company that meets that strategic acquisition criterion. That said, it's just as common, probably even more common to be truthful, that for us to deal with what we'd consider to be a kind of tactical or reactive approach. So you become aware of, through your network or connection, you may be approached by a broker with a business that's for sale. You may be aware of one through some kind of website or business brokerage service, and you identify or happen upon a company that you're interested in, or at least in theory, you're interested in. And a key part then, when we're dealing with a more kind of tactical approach, is to work with you to find out the information we can before, if you like, the deal is progressed on to absorbing a lot of your time and our time. So we'll really be looking at what the market segment looks like, what competitive there are in that sector, what other deals have gone on, what kind of valuation ratios seem to be commonplace in the sector concerned. And of course, that leads ultimately to the issue of a preliminary view on valuation. And that's obviously key, both from the purpose of determining whether or not you have the appetite to do the deal, but also to make sure that the finance metrics, which we're going to come on to in a moment, work in terms of the deal. That's typically phase one, if you like. Now, where we've done a strategic approach, then we can approach the potential vendors on your behalf. So if we've worked with you on drawing up a list of potential targets that meet your acquisition criterion, then generally speaking, we'll get to a point where there's a short list identified of those companies that we collectively have an appetite to approach, and we will approach those on your behalf. I won't bore you with how we go about doing that, it's not important, but we can reach out to them at that stage without you being identified as being the potential buyer. Clearly, if it's a tactical transaction, then usually the go-to contacts are part of the if you like, the kind of tactical documentation that's available. Clearly, at that point, we'll be still very much in the stage of gathering the information to determine what the likely range of valuations are going to be, and I kind of liken it to a kind of an early stage in a boxing match. We're kind of, we're ducking and we're moving. We're looking at shaping out the shape of the deal, what the expectations of the vendors are, where the business is already for sale. We'll most certainly be, and Steve will come on to this in a minute, but we'll most certainly at that stage be beginning the process of assessing what the options on financing the deal are. Now, some of you will be wealthy enough, rich enough to look at doing a deal without the need for external finance, but that is the exception. And generally speaking, at this stage, we'll be beginning the journey of talking to potential funders about what kind of funding structures might be available, what different types of finance might be available to support the deal. And those of you who have attended the Funding for Growth webinars will know that different streams of funding have quite different costs associated with their if you like, their appetite to risk and return. So at this stage, we'll be looking at what is the lowest cost option of financing, what asset-backed vehicles are available, what secure debt vehicles are available, so we can start to help you shape what the deal is going to look like. And at this stage, we'll certainly be beginning the process of planning the due diligence phase. Now, I'm kind of going to approach this now a little bit back to front, because due diligence takes place later in the process. But so just to touch on due diligence, I mean, certainly there is a degree of due diligence that's happening almost from the very beginning, because we're gathering data that is publicly available or that has been made available to us as part of the tactical or strategic approach. We'll certainly be looking at what the tax structures are. I mean, Nick will join us later, will tell you that it's never too early really to think about the tax implications of a deal. And, at this stage, we'll be looking at what might be the options available to you. Because if you do, as Nick will cover, if you do kind of consider this issue early enough, then there may be some more exotic tax options at our disposal that might not be available later in the deal cycle. Where forecasts have been provided, we'll be doing some sensitivity tests for you. We'll certainly be looking at the obvious traps, even at this early stage of, any kind of gaps in pensions or pension funding, what might be the employment or 2P implications, So we're doing a kind of early stage due diligence. It's not the same as the financial due diligence that takes place at the later stage of the deal, where we're very much looking at, do the financial support, the working capital plans, and the financial forecasts that are available. So we'll be doing this kind of early stage acquisition due diligence just to advise you on what the obvious implications are. What are likely to be the areas where we're going to be seeking some comfort later stage from the lawyers when they get into warranties and indemnities? So let me hand over now to Steve, because we've done that preliminary stuff. We've determined that there's a deal here we want to do. It looks to be viable, it looks to be feasible, and really at a quite early stage, we're going to involve Steve, or the likes of Steve, to look at what the finance options are available. Steve, do you want to take it?
Yes, thank you, Paul. Can I have the next slide, please? Right, so we can do all types of acquisition funding, and we take you through the process right at the beginning, right through to the very end and beyond, because often lenders will require a degree of monitoring of the deal post-completion. We can get involved in that as well. Our role, well, really is outlined there in the grey box, and I don't intend to go through that word by word, but generally it can be summed up in by saying we help you gather the information that any lender will need, and crucially we're presenting it in the right way to the lender at the right time. We know from our connections and our experience what information lenders want. We also know what information will set hairs running, and we know how to present that in a way to head that off at the pass. So our role is really packaging information up in such a way as to give you the best chance of raising the finance with any lender. And part of that will take the form of, as Paul's already said, informal conversations with the lender at an early stage of the process to see what the likelihood of any chance of a particular deal going ahead will be. In today's market, there tends to be one or possibly two lenders that are suited to each particular deal. If you go back 10 or 15 years, then lots of banks and other institutions were doing this kind of acquisition funding fairly loosely. And back in those days, you had almost a beauty parade scenario where you had 3, 4, 5 lenders lined against each other who'd give the best terms. Nowadays, it's more about selecting the right lender right at the beginning to fit each particular deal. And that's not just about fitting the deal as it's on the table in front of you, but also fitting your future aspirations. So for instance, if you're going for a buy and build strategy and you're looking at your first acquisition, you need to know that you're going with a lender who will be up for doing follow-on finance and will back you as a management team to do that sort of buy and build process. The whole benefit of our involvement at a very early stage with the lender is that we quickly get a steer on appetite, so it cuts out wasting our time, particularly wasting your time. We kind of front it for you with the lender, and that gives us the chance to have back channel conversations. Will this work? Will that work? And that falls into almost plausible deniability, because if you were to have the conversations with the lender, that's almost, it comes back to the thing, you never get the first chance, you never get a second chance to make a first impression. Next slide, please. So there's two basic approaches to funding any deal. The one in the grey box on the left is the normal, let's call it traditional approach, where you're lending against the assets of the business. There's any number of lenders out there who will lend against security. We see it in the property market, we see it in the machinery market, we see it wherever there is something of value that you can touch and feel and take possession of. There is normally a number of lenders out there who will look at that sort of thing. It's very suitable for businesses that have quite a rich balance sheet, lots of plant and machinery, maybe a large debtor book in there, that kind of thing. The lenders that tend to favour this approach are the ones that tend to have bank in their title. So all the main high streets, people like Sherwood, Aldermore, Metro, all the traditional high street banks and challenger banks. And they take this approach because if they can take tangible security over a deal, they have less regulatory issues with the money that they're raising, because they don't have to hold so much of their own capital on the balance sheet. So they can't take the easy route. So that's the traditional approach. Suited to some deals, most deals that we're seeing, it's very much a second option. On the right, in the white box, you've got the cash flow loan approach, which is less reliant on the security of any assets within the balance sheet, and it's more based around the historic and future projected earnings of the business. So the way that's normally expressed is earnings before interest, taxation, depreciation, amortization, EBITDA. So that is a measure of how much cash the business actually generates. And these type of lenders will look at the historic EBITDA number and generally lend between 2 and 3 times that amount in order for you to acquire the business. And we know on those sort of metrics that repayments are generally feasible within cash flow at that sort of level. There's typically fewer lenders in this particular sector, and they don't tend to be banks. They tend to be more institutional investors who are managing large investment pots, pension funds, that kind of thing. It works where you have businesses that might be very profitable, but they haven't got a lot of assets on the balance sheet, or in particular where you've got a deal structure where there's a good amount of deferred consideration or rollover shares or an earn-out component. The lenders in this category tend to like that sort of thing because it spreads the risk between the parties, like I might have in a moment. It does remain the case that for any acquisition, more so on the cash flow side, but this applies slightly in the ABL side, that it's always easier to raise £3 million than it is to raise 300,000 to do an acquisition. And the reason for that is that the deal costs tend to be the same whether you go for the lower amount or the higher amount. You still have to do the same amount of due diligence, you've still got the same costs, the lender has to put in the same amount of work. So a lender would rather look at a larger deal than a smaller deal. That's not to say we can't do smaller deals. There are lenders out there who will do the sort of 250 to 750 funds out kind of range, but there tend to be there tends to be less of them. Next slide, please. Okay, so what lenders expect, and this is what I touched on just there, and they tend to expect an alignment of risk. So that's between the buyer, the vendor, and the lender. The risk from the buyer's point of view, any lender will want to see you put cash into the deal yourself. Typically, it tends to be between 10 and 15% of the deal value, although some lenders do between 10 and 15% of the loan amount, which can be materially different. So again, that comes back to selecting the right lender for each particular deal. Lenders will also expect the person selling the business to take on some of the risk through deferred consideration, loan notes, some kind of contingent structure, and that helps the lender reduce their exposure and put less money out and still get the same result. Where that has material consequences is we've seen deals in the past where an acquisition has failed a couple of years down the line. And because the former seller still has loan notes in there, the lender has brought them back in and used that to revitalise the business. And with the former owner running it, the lender has more of a chance of getting repaid. So that's why they tend to insist on that. Of course, in most cases, things will proceed without too much trouble, and everyone gets paid out, and there's not a problem. You can see the other things in the grey box that lenders are looking for, and they tend to be the fairly straightforward things: good management team, ability to service the debt, you need a good set of projections, that kind of thing. One of the points on there is sector preferences. So there are lenders, most lenders don't like, for example, construction. At the moment, most lenders don't like hospitality or retail businesses for obvious reasons. But there are also lenders who have either particular quirks or particular specialisms. So, for instance, there are a couple of lenders out there who are very specialist who will do construction stuff. There are some lenders out there who are very funny about businesses connected to military applications. So, for example, they wouldn't want to get involved with a business that was machining parts for exocet missiles or something like this, because there's perceived reputational risk. Tobacco is another obvious one that a lot of lenders avoid. But there's not many businesses like that knocking around. We just have to be quite careful that none of the customer base for any of these businesses that you're looking at has any links to anything that a lender might consider offensive in any way. I think that brings my section to a close now. So if I can hand back, I think, to Paul.
Thanks, Steve. So we're going to get into the tax implications on the deal in a moment, and hopefully Steve has covered off some of the aspects of arranging and managing the process of securing finance. I think it's probably just important just to re-emphasise the point that quite a lot of that background work, both in terms of the way the deal is structured and the way it's financed, is done before an approach is even made. So it's not an uncommon thing for Steve and I to be working together. An example will be a deal we're working on for a client who showed an interest in a company. We gathered the information, we looked at some competitor analysis, we looked at some similar deals in that sector to give him and us some guidance on what kind of multiples we thought we were going to have to get to make an offer attractive. Having got to a kind of range of valuations, we started to put together what kind of deal structure might work, and had already made approach to a couple of potential finance providers before even the first kind of meaningful step was taken in engaging with the vendors in that particular instance. So it's just to give you a flavour for the background work that goes on. And I guess that probably encapsulates the middle word on this slide most effectively. I mean, probably the key role I would suggest we perform from a corporate finance perspective during this is to manage the various components of what can, become quite a complex project. So back to the process. We've done the initial, shaping of the deal. Now we've approached the potential vendor. We've got some ideas on finance itself. We've begun to map out maybe the steps of due diligence which will take place once the heads of terms are agreed, and really what we're now going to get into is looking at what are the tax implications of the way the deal might be structured. And again, as Nick will no doubt allude to, it's never too early to get some kind of tax input into the early stages of the deal. So if I now hand over to Nick Wright, my colleague, who's the tax expert at Jerome, so he'll take you through what some of those tax implications are. Nick?
Thanks, Paul. Yeah, I think I'll mainly be looking at whether or the tax implications of purchasing a business either via the acquisition of the shares in a company or the purchase of its assets. But as Paul said, really, it's the sooner you start to think about how these can be structured, the better, really. Just an example of a transaction we've done recently. There was a wholesale and a retail trade within one company. A buyer looking to acquire the wholesale trade, in terms of the tax implications for the seller, just buying that trade from that company would mean quite significant income tax implications in having to take the cash out as dividends and corporation tax on the sale of the assets. Whereas we were able to get in quick enough that we could actually demerge that wholesale trade from the existing group. The buyer was able to just acquire the shares of this new company, which they were happy to do because it was a new company, so there weren't any history of liabilities, and that had significant tax savings for the seller, which obviously then leads on to an agreed purchase price that the seller's more happy to accept. So the sooner you can start looking at how you're going to structure a purchase and exactly what parts of the business you might want, if you don't want all of them, the better, so you can actually look at these sort of reorganisation routes if it's required. Obviously not in every case. There's plenty of cases where it's simply the entire business or the entire company that you're looking to acquire, which is probably slightly more straightforward. But certainly we'll then have a look at, in that case, whether you're looking to acquire the shares in that company or the assets. So if I could have the next slide, please, Paul. So what I'm talking about when I'm saying the purchase of the assets, that is the assets, the goodwill, plant and machinery, stock, any intellectual property held within the company will be acquired. There's some major benefits of that in terms of leaving behind any liabilities or assets that you don't want. Typically, it gives the buyer more control as well in terms of being able to cherry pick. In contrast, the purchase of shares is obviously buying everything in the company, unless you, as I said before, you're going to demerge a part of the company. If perhaps the seller wants to retain some property, they might need to demerge that property in the first instance. But other than that, you'll be taking across all assets and liabilities. And because of that, it can be slightly more complex in terms of having to have additional warranties and indemnities within the legals. So just moving on then to some of the tax consequences of a purchase of assets. If I could have the next slide, please, Paul. As I say, the main thing will be the acquisition of assets, and what I'm looking at initially is the plant and machinery. So as you're buying assets, they're new to the buyer, therefore capital allowances are likely to be available. Currently, we've got a very genuine annual investment allowance of £1 million. So any assets that you acquire that qualify for the annual investment allowance, up to £1 million, you could have relief for those in the first year against other trading income. So that could be a major benefit of acquiring the assets directly instead of the shares. Also, where you're looking at land and buildings, there's the opportunity to effectively reset the base cost of those land and buildings to the market value today and the amount that you pay for them. Obviously, the downside from the seller's perspective is that they're effectively incurring the cost of that reset, so that again there might be some tax implications for them that they'll want compensating for. Also, in terms of land, you're acquiring land directly, so you've got stamp duty, land tax charges. Goodwill is quite a complex area that has changed a number of times over recent years. The latest change being in 2019. Generally speaking, there's no tax relief for goodwill that is acquired, or any other what's defined as relevant assets, which is essentially anything customer related. However, 2019, there was a change that did relax this slightly. It allowed for a 6.5% writing down allowance, but that only applies where it's as part of a business acquisition, and the goodwill is acquired alongside other intellectual property such as patents, copyright, registered trademarks. So it's still quite restrictive, but there is potential relief for goodwill in certain cases. Tax losses is a big one in terms of purchase of assets. If the company has historically made losses or has losses available to use in the future, by buying the assets of the company, those will be lost. The losses will always remain with that company. So certainly something to consider if there is significant value there. Moving on to the next slide. VAT is another important one to be aware of in a purchase of assets. Mainly, in the main, you can get around having any issues with VAT under the transfer of going concern rules. The key thing to be aware of is to ensure that those conditions are met, and to meet those conditions, you'll be looking at making sure that there's a transfer of either the whole of the business or at least a part that can be operated in its own right. Must be as a going concern. The buyer, if they're not already VAT registered, needs to become VAT registered, and they need to continue in a similar kind of business. Employees are also one to be aware of. They're not going to automatically remain with the existing company, and I'm sure Jeremy will touch on this in a bit more detail, but effectively if employees are to be transferred over, then we'll need to be looking at the 2P legislation on the legal side of that. So just moving on then to the advantages of purchasing assets. As I think I've probably touched on a lot of these already. You can leave behind any unwanted liabilities, or the seller can retain any assets that they might want to. Typically, retaining assets would be some sort of investment properties. Sometimes you get companies where they've literally just put all kinds of assets in there, even if they don't necessarily relate to the trade. So there might be some unravelling to do there, but a purchase of assets makes that more straightforward. As I say, with the purchase of shares, you're likely to be having to consider demergers prior to the transaction. Because the agreement specifies the assets that are being acquired, there's typically less due diligence required, which is another benefit of a purchase of assets compared to the shares. Also, if the buyer has made disposals of land and made some capital gains on those land, or fixed plant and machinery, they're typically the two main assets that relate to rollover relief, then acquiring similar assets in this new business will open up the potential to elect for rollover relief and defer any capital gains, and defer the tax that's been charged on those. So that can also have some significant value in certain cases. And as I've already said, capital gains based costs of assets, resetting those to market value, reducing the capital gain in the future when you do come to sell those assets is also another key advantage. Moving on to a couple of disadvantages on the purchase of assets. As I think I've already alluded to in a number of different areas, really the seller is likely to have higher tax liabilities. By selling the assets in the company will incur tax at current corporation tax rates of 19%. After April 23, we'll be looking at tax rates even up to 26.5% when you look at the marginal tax potentially falling into those bands. So following on from the 25%, 26.5% higher tax rates for the company, the sellers are likely to then want to remove those proceeds to have in their personal hands. So again, how they do that, the potential for capital gains on liquidations, but otherwise they're looking at dividends at to 38.1%. So the seller might need compensating for that if purchase of assets is the required route. The other issue with purchase of assets where land and buildings are involved is stamp duty land tax. As I've said, rates could be up to 15% in certain cases, so certainly one that needs looking at sooner rather than later. Moving on to a purchase of shares, then tax consequences. A lot of them are kind of touched on in the purchase of assets in kind of the opposite way. So tax losses we've already discussed. They stay with the company. So if you're acquiring the company and they've got losses, then there's potential to utilise those in the future or to group relieve them in certain cases as well. There is some anti-avoidance out there to be aware of, where if there's any major changes with the company, such as changing activities, markets, customers, suppliers, within a 3-year period, then those losses cannot be carried forward past the change of ownership. So it's important to be aware of that if losses are have got key value. Also to be aware of is if you're purchasing the shares and they'll become part of another group company, quarterly instalment payment limits are reduced, and as I've said, in terms of what they announced in the budget with the increased rates for corporation tax, we're still waiting on the Finance Act to become law. However, we're likely to be looking back at, as I say, the 25% or even the marginal rates of 26.5%. So additional group companies are likely to have an effect on that. Stamp duty, rather than stamp duty land tax, stamp duty is payable on the acquisition of shares, although the rate is only 0.5%, so likely to be sort of a less significant cost in many transactions. And VAT is a nice easy one in this case. There is no VAT on the purchase of shares, so that simplifies the purchase of shares route. Advantages of share purchase, again, generally the opposite of the purchase of assets. So simplicity, it's already everything's packaged up in a single company. As I said, it might get more complicated if certain assets aren't required or the seller wants to retain some, but if it is just a straightforward purchase of the business, then that can be quite a simple route. If there's value in the business name, obviously acquiring the company with its name can be useful, and reduces costs and administration and professional fees. So those are some of the advantages. Disadvantages, you're requiring everything, as I've said. Liabilities, if there's anything unknown on the balance sheet, then obviously you'll want to identify those via due diligence. Anything left that obviously not everything can be, you'll be looking at using warranties and indemnities within the legal paperwork to cover you for that. Buying a company with history, very much what I've said really, undisclosed liabilities and requiring the warranties and indemnities, and the stamp duty. Although it is only 0.5%, certainly in the bigger deals, 0.5% can become quite a significant cost. And then finally, this final slide really just compares some of the tax implications in a table here. So for capital allowances, purchases of shares, there is no capital allowance impact, whereas a purchase of assets, there could be some annual investment allowance to reduce trading profits, particularly with that AIA so as high as it is at the moment. Stamp duty, 0.5% on the purchase of shares, no stamp duty on a purchase of assets, but stamp duty land tax could be quite a significant cost. VAT, unlikely in both cases, but it's just important in the purchase of assets that the TOGC rules are met. Losses, purchase of shares is always a benefit if there's significant losses, and employees, purchase of shares, they're unaffected, they remain with the company. Purchase of assets, you'd be looking at transferring them under the 2P legislation. So that's a very quick rundown of some of the key advantages, disadvantages and tax implications of purchase of shares or assets. And obviously there's a lot more involved, and as you go through the process, as Paul said, really it's about identifying which is the preferable method for both parties as early as possible, so that the legal paperwork can be drafted in the correct manner. And I think that leads me on to just passing it over back to Paul and on to Jeremy.
Yeah, thanks Nick. So again, I hope that illustrated that it's never too early in the process to start thinking about how the tax implications work. I mean, Nick and I are working on a deal at the moment where it would be fair to say that it is constructed in a way that is suboptimal from a tax perspective, and it's quite difficult once you find yourself in that position to kind of unwind the kind of the implications of, or the way the deal's going to progress. So we're kind of caught in between a rock and a hard place on that deal, really. But important to get tax early on. I'm going to hand now over to Jeremy. I'm conscious that time is pressing on. Jeremy is a close friend and a colleague, but works for the Wilks Partnership, and I'm going to hand Jeremy just to talk through some of the legal implications of buying a business. Jeremy?
Thanks, Paul. Morning, everybody. So I'm a consultant at the Wilks Partnership in the corporate team. For my sins, I spend most of my days buying and selling businesses, and within the corporate team at Wilks, we probably handle 60 plus transactions of this type every year. We also provide a full service to our client base, which is mainly SME client base, so clients much like yourselves. And we work very closely with Jerem's on this type of acquisition and disposal work, as well as other client matters. I'm going to dive straight in, Paul. Next slide, please. The agenda is really trying to just work out the legal process. And as we've discussed, as Nick's gone into some detail on, yeah, you can move on. Thanks, Paul. You can move on to the next slide. Thank you. The difference between assets and shares is the key. So with an asset purchase, you can, as Nick says, cherry pick your assets and liabilities. So if there are, for example, assets that you don't really want to purchase, such as a freehold property, then you can leave that out of the equation and reduce the price accordingly. If there are liabilities that you don't like the look of, then obviously you can try and negotiate those out as well. Nick's covered the tax considerations, which are really from the seller side, and they include capital gains tax and what used to be entrepreneurs relief. So whilst you can cherry pick, you need to bear in mind the seller's expectations and the price negotiation alongside that. Nick again mentioned briefly TUPE. So if you're looking at an asset purchase, you may think you can, as well as choosing your assets and liabilities, you can also choose your employees, but unfortunately that's not the case. So the TUPE legislation, its full name is the Transfer of Undertakings Protection of Employment Regulations, and that's exactly what they do. They protect the employment of the staff within the business. So when you buy the business, all of the employees in it will transfer over to you as a matter of law, and they will come on their existing terms and conditions and with all their accrued rights and benefits. So there isn't any clever way in doing an asset purchase where you can select the staff you want and leave some of the staff behind. They will simply just all come across to you. With a share sale, as Nick's pointed out, you're buying the whole company, so you're buying all of the historic liabilities, the sort of actual and contingent liabilities, as well as any future liabilities. So it's a bit like buying a cupboard. If you buy the cupboard and there are skeletons in it, then you get the skeletons with it. So you just need to be more careful in terms of the due diligence which you're going to do. So once you've decided on the shape of the deal, you need to look at summarising the key terms, really, and we normally do that by a short sort of 2-page, 3-page document called a heads of terms or heads of agreement, or sometimes a memorandum of understanding. It's a non-binding document, generally speaking, but it summarises the commercial terms, the key elements of the deal. And it's important to do this because surprisingly often we get quite a long way down the track with a buyer and a seller, and it becomes apparent that in fact they have different expectations regarding some key elements of the deal, and so there's a sort of standoff until that gets resolved. And obviously you're starting to spend money on professional advisors, so you want to make sure that you've got the deal properly agreed up front and there are no sort of time wasting standoffs and additional documentation or redrafting required further down the track. The heads of terms often contain some sort of protection for the buyer in terms of what is being purchased. So particularly in regard to the balance sheet, there's often a provision which guarantees a minimum level of net assets at completion of the deal, so that the seller can't strip out cash and so forth. And also we consider putting in a provision to protect working capital, so that when the deal completes there is adequate working capital in the business, and in either case the price can be adjusted if that's not the case when the deal is actually done. You'll also want to look at an exclusivity period, so that the seller commits to you not to negotiate with another buyer whilst you're doing your due diligence and trying to finalise the legal documentation. So generally for a period of 2 to 3 months, you're requiring the seller not to negotiate with anybody else, but just concentrate on getting the deal done with you. And that's an element of the heads of terms, which is a binding agreement. So if you end up wasting costs because the seller is dealing with somebody else and eventually sells to somebody else, then you have some recourse in that respect. Next slide, please, Paul. So we've discussed the sort of financial due diligence which Jerem's or your accountants would normally do for you. And alongside that, you obviously need to look at the legal due diligence. So that is just an exercise of reviewing key aspects of the business to make sure that they're all in order. This will include things like key customer contracts and supplier contracts, funding arrangements, leases, finance agreements, bank facilities, and that sort of thing. It looks at employment contracts, pensions and other benefits. If the business has important intellectual property, then it will review that and check that out. It will look at IT systems and contracts. So just to reassure that everything in the business from a legal point of view is as it should be. Depending on the nature of the business, it's important to focus with your advisors and solicitors on key areas. So you need to look at where the value is in the business and where the risk areas are, and focus the legal due diligence on that. It's effectively a fact-finding and risk assessment exercise, and it ends up in a legal due diligence report. Normally we do a report on what we call by an exception basis. So instead of giving you a vast long report on boring photocopier leases, we actually just focus on reporting anything unusual in the business or which constitutes a material risk to the business. And that may identify issues which need to be dealt with in the sale and purchase agreement, and if there are serious issues they may even go to pricing and cause you to look again at whether the pricing is right. Thanks, Paul. Next one, please. So coming on to the sale and purchase agreement itself, the SPA, the main content is fairly obvious. So it's what you're buying, how much you're paying for it, and how you are paying for it. That's probably well understood. What is less well understood, if you haven't done this exercise before, is that there'll be a set of what are called warranties. Now that's in a schedule to the sale and purchase agreement, and these are a long set of representations by the seller, effectively that all aspects of the business are compliant and as they should be. And that's a protection for the buyer in terms of, you know, any skeletons which might come out of the cupboard should in fact be caught by warranties, and if there's a breach of the warranties, then the buyer is able to make a claim against the seller. The SPA may also contain indemnities, which we can come on to, and it will contain a tax covenant or a tax indemnity. And the purpose of that tax indemnity is to draw a line as at completion and to make the seller liable for all tax in respect of the period prior to completion, and the buyer liable for all tax arising in respect of the period after completion. So normally there'll be provisions in the accounts which cover the tax up to the date of the deal, but to the extent that they're inadequate or other tax liabilities arise in respect to that period, then the buyer will be able to claim the amount of that tax from the sellers. Another key element in the sale and purchase agreement is the limitation of liability. So the liability of the seller is normally capped at the value of the deal, so the price of the deal. There are time limits generally for the buyer to bring a claim, usually about 2 years to bring most claims and 7 years to bring a tax-related claim. And there are often what are called de minimis provisions, which mean that if a claim is very small, there's simply no right to bring it, which is just to stop a buyer putting together a string of trivial claims, which is a bit of a waste of time in the great scheme of things. In giving the warranties, the seller is then able to tell you about any issues which are not consistent with the warranties. So if there's a warranty that there's no litigation, the company's not involved in any litigation, for example, and there is some sort of claim, then that can be disclosed, and that is done in what's called a disclosure letter. So that is the seller confessing its sins, if you like, so that you can not claim in respect of any issues which have been brought to your attention by the seller through the disclosure letter. And normally attached to that are a number of documents which relate to the disclosures the sellers are making. Finally, in the sale and purchase agreement, you will want a non-compete provision or a restricted covenant. So having spent all this money on buying a business, the last thing you want is for the seller to come back into the market and compete with you. So it's normal to have a restriction for a period of up to 3 years, which is about the maximum enforceable period, which stops the seller competing with the business or the company that you bought off him and stops him soliciting customers and poaching staff. Next slide, please, Paul. So we've talked a bit about structuring the consideration, and Steve's given us quite a lot of insight into how the deals may be funded. Normally there's some upfront consideration, but it's usually not the full amount of the price, and there is deferred consideration. Steve talked about asset-backed lending and using targets receivables to the target company's receivables to help fund the deal. There may be bank funding. Often if the payments are made over time, so some of the consideration is deferred, this is done by means of loan notes. This is effectively an IOU issued by the buyer to the seller. The loan notes are repayable in instalments over a period of, say, 1 to 3 years, probably interest bearing, and they can have some tax benefits for the sellers in terms of capital gains tax, its quantity and when it's payable. There may also be some performance related element to the consideration, or what we call an earn-out. The benefit of this from the seller's point of view is that it's an opportunity to maximise the price, provided that the business performs to expectations over the 2 or 3 years after it's been bought. And similarly for the buyer, it means that they're not having to pay the full value for the business up front. They can wait, and the consideration will be adjusted depending on the performance of the business once they've purchased it. And then finally, in terms of payment, where there is deferred consideration of any type, it would be usual to have a right to set off against that payment any claim which the buyer may have under the sale of purchase agreement. So if there's a claim for breach of warranty or a claim for tax which hasn't been provided for, then the buyer can withhold that amount from any payment of deferred consideration which has to be made to the sellers subsequently. Next slide, please, Paul. You need to be thinking before completion about what happens after completion. So in terms of transition and handover, it may be that you need to be looking to 1 or 2 of the sellers to help you with that process. So you might want to consider a consultancy agreement with 1 or 2 of the sellers so that they can help with a handover and transition of the business for a period of, say, 3 to 6 months after completion. You'll need to be thinking about any issues which arose during the due diligence, particularly the legal due diligence. So if certain contracts of the business or terms and conditions which the business uses are not up to scratch, then you'll want to put improved versions in place from completion. And you also need to look at the management team who you're going to be inheriting. So if the 1 or 2 people who own the business leave, there's still management in place and you need to look at retaining them and incentivizing them. So you ought to be looking at new employment contracts or service agreements for them, and possibly bonus schemes for them within those contracts, and even considering something like a share option scheme in order to incentivize the management and help them share in the growth of the business. And there are some very good tax efficient schemes available, such as EMI, which we can advise on. Next one, please, Paul. So last one we want to look at are distressed sales. Typically, this is where the company is on the brink of going bust or has already appointed an insolvency practitioner, such as an administrator. They're always done under an accelerated timescale, and that means that there's limited opportunity to do due diligence. So it's a higher risk opportunity for the buyer. The deal is always structured as a sale of assets and liabilities. And if it's a sale by an administrator, you won't get any warranties about those assets and liabilities or the business. So again, that puts it in the higher risk category. But if it's a business in an area that you know, a sector that you know that you're already in, and you've got a pretty good idea what's what, then the big attraction of a distress sale is that you can get the business for a very low price and get a very good return on it. That's just a quick whistle-stop tour from me, so I'll hand back to Paul now, and I think we can take some questions after that. Thanks.
Yeah, thanks, Jeremy. It is a whistle-stop tour, and obviously there was quite a lot of content you've been through, so forgive me for that. I'm also conscious that we're quite tight against the 1 hour I promised that we would try and keep the webinar within. Notwithstanding that, if there are questions and people don't mind, I'd sooner we run on through and deal with any that are arising. So Sharon, I can't see them obviously here, but can you tell me what questions have arisen, if any?
Yeah, there are a few, so thank you for those of you that have submitted them. I think the majority have been covered during the course of the presentations, but there's just a couple I'd like to pass over. The first one is, any additional considerations for a partnership structure acquiring shares of a limited company or vice versa?
Sounds like a legal question. I mean, I can't think of any special implications of a partnership structure requiring a limited, but what are your thoughts, Jeremy?
No, I agree, Paul. There's no difference in principle whether it's a partnership acquiring or another limited company.
I'll just jump in. I think a partnership structure acquiring shares of a limited company, there's not too many issues from a tax perspective. Partnerships are looked through for tax purposes, so that there's not really any issues there. Vice versa, though, a limited company acquiring partnership, there are tax implications of that, and probably something to be looked at in a lot more detail off the webinar. But the main thing to point out there is that a limited company owning a partnership share converts that partnership into a mixed partnership. So there's a number of different anti-avoidance rules that apply to mixed partnerships, effectively brought in quite a number of years ago now, but they were brought in to stop partnerships being able to filter their profits through the limited company and therefore pay the lower tax rates that limited companies could apply. So as I say, partnerships acquiring limited companies, no real issues there. Limited company acquiring a partnership, though, certainly something you need to look at in a lot more detail, I'd say.
Thanks, Nick. Sharon, next question.
Yeah, sure. What support can you offer a management team undertaking a buy and build strategy under any sector?
I mean, I think it's a good question, and I think the spectrum really. I mean, I think we work with a number of buy and build teams. I think, as Steve covered off, and he might want to jump in here, that the choice of the finance provider early on can be a factor when you're doing a buy and build strategy, because clearly we're not looking at putting the funding in place for a single deal, and I think it's therefore becomes important to to be a bit more nuanced in the selection of the potential finance provider. But in terms of the process thereafter, in terms of strategic acquisition search, due diligence both before and then financial due diligence after, legal framework and that kind of stuff, and working with a single team on a buy and build strategy, a single advisory team, can often be a way of mitigating costs. So when people like Jeremy and Wilkes are employed and working on the legal documentation, there's a kind of, I hesitate to use the word template, but there's almost a kind of deal set of documentation that can be brought into play that can serve subsequent deals and thereby mitigate some of the cost being duplicated. Anybody else want to chip in on that point? Have I covered off the main advantages there? You're all quiet, that's good.
Okay, lovely. And I think we've just got time for one more. Are you anticipating any changes to entrepreneurs relief in the autumn statement?
I might hand that one over to Nick. I mean, I think if we were crystal ball, it's not entrepreneurs relief anymore. It's now called business asset disposal relief, or BAD. And I'm always a bit nervous about any tax relief that's called BAD. Doesn't sound to me like it's got a great future. I think for what it's worth, and I'll ask Nick maybe to make a more expert observation, but for what it's worth, I can't see the tax relief getting any more generous anytime soon. Will it get poorer? I kind of doubted. The changes over to BAD were only from entrepreneurs relief to BAD were only made in the budget of last year. So I think that was, Nick will correct me, but I think that was March 20. So it's quite new. Nick, any comments on that one?
Yeah, I agree. Really, I think they've obviously restricted the lifetime allowance from 10 million to 1 million already. So further, personally, I think they're more looking at the general capital gains tax rates, obviously with the OTS reports, and there quite a lot of press out there that was suggesting that they would be looking at increasing capital gains tax rates. But I think they've already made quite a big dent in business asset disposal relief or entrepreneurs relief last year. So yeah, I personally think probably capital gains more generally is what's more likely to be attacked than business asset disposal relief.
So we don't think it's going to get badder, but we don't think it's going to get good either. Sorry, couldn't resist. All right, thanks everybody. Sharon, is that it? Are we done?
Yeah, that's the end. Thank you.
All right, thanks everybody for joining. Appreciate
Thanks a lot.
Taking the time. Thanks.